FX Nation, what's up guys? Welcome back to ForexU and welcome back to our advanced course, guys. So as we move along, guys, through our advanced course, this week in this video, we're going to go ahead and we're going to break down, drumroll please, we're going to talk about trading gold. All right, so we're going to talk about trading gold this week. I've been doing a lot of research on this particular pair, and so I'm just going to share with you my findings, and hopefully they should be able to help you trade gold. All right, and it may not be as difficult as you might think, actually. So let's get right into a couple things about gold. All right, when we talk about trading gold, there's definitely some rules that we need to follow that are a little bit different than what we're accustomed to with trading a currency pair. And so we're going to go over those rules, and I'm going to share with you some facts about gold that I've discovered myself. All right, so let's literally go ahead and let's jump right into it. So the first things first, let's talk about gold facts. All right, and literally these are just facts. That's what they are. So first one, all three types are present in the charts. So meaning that you can trade your type 1s, your type 2s, your type 3s. They all appear in the charts. That's fantastic. That's great. So really when it comes down to that aspect of your trading isn't going to change because you're still going to be looking for the same thing. Okay. Second, all three cycles are present in the charts. So all three types, type 1, 2, and 3, are definitely present in the charts, and also all three different types of cycles. So we're talking about accumulation cycle, we're talking about market maker cycle, and we're talking about trending cycle. So all three cycles do appear in the charts. Now, a couple of facts about the cycles. Since 2018, there's been 44 market maker cycles, 47 trending cycles, and 40 accumulation cycles. Okay, so those are the facts. So I went back in time to 2018, January 1st, and from 2018, January 1st through today, there's been 44 cycles of market maker, 47 of trending, and 40 of accumulation. I literally went back and I plotted every single week since 2018. Okay, so we definitely know it's a fact that all three cycles appear. All right. Another fact, over 33 times there have been back-to-back cycles that are the same. Meaning, one thing that I've noticed a lot of on this pair is that it likes to do back-to-back of the same cycles. So meaning back-to-back trending cycles, back-to-back market maker cycles, back-to-back accumulation cycles. As a matter of fact, there have been plenty of times, I would say out of the 33, I would say maybe 10 of those were ones that were actually 3 weeks in a row. So 3 weeks straight of trending, 3 weeks straight of market maker, 3 weeks straight of accumulation. Okay? So all those things are facts on gold since 2018. All right. So how can we use this to help us trade gold? And what are the differences? The real important thing is, what are the differences between trading gold and trading a regular currency? All right. So let's talk about those. So the differences between gold and other pairs, other forex pairs. So the first one is stop losses are going to be bigger. Hands down, no ifs, ands, or buts about it. Stop losses have to be bigger on gold. And a lot of it has to do with the really big movements that gold does per candle, and really the pip value is very extremely high on gold. So gold is one of those pairs that is really good for building an account if you know what you're doing. It's really bad because it could also blow your account really fast if you don't know what you're doing. Okay, so bigger stop losses on gold have to be done. Another thing is your risk to reward is going to be different. Okay, so risk to reward ratios are definitely going to be different on gold than when trading a regular forex pair. So stop losses are bigger, risk to reward are going to be different. So when we talk about stop losses, we're talking about stop losses that are at minimum 30 to 65 pips big. So 30 to 65 pips big are going to be your stop losses. Okay. If the trade is like, if that candle is too big, like it's just too big, right? This is like literally the minimum that you're going to have to put your stop losses because of the pip value so high, and the ranges that this thing does is ridiculous. Okay. And then your risk to reward ratio is going to be 1.5 to 1. So with regular forex pairs, we do the 2 to 1 risk to reward ratio. This one is going to be 1.5 to 1 because our risk is way bigger. Okay, now a lot of times because the pip value is so high, when you have moves on gold, I mean, it literally moves like really big, well over 100 pips on a regular basis. So it's not like it does it once in a while. Like this thing on a regular basis moves well over 100 pips. Okay, so I put the risk reward at 1.5 to 1 because we want to make something that's easy reachable for most of our trades. If we start doing 2 to 1 or higher, then we're going to end up taking a lot less trades. And I mean, we're already looking at very specific setups on gold as it is. Okay, and so we're going to look at the charts here so we can show you some differences of the setups that are there on gold. But definitely the setups are there on gold. All three types, type 1, 2s, and 3s are there. The cycles are there. You have to make an adjustment on the stop losses. You have to make an adjustment on the risk to reward ratio. As far as entries go, entries are pretty much going to be the same thing as before. If you're an aggressive trader, above or below the 13, or you can wait for the crossover to happen. Because of the pip value and because of how quickly this moves, you're probably going to have to do the close above or below the 13. Because by the time that crossover happens on the next candle, price could be pretty far out if you don't get a nice retracement. And you do get retracements on this, by the way, but just saying, you know, with anything, when you do your back testing on this, and this is a pair that you definitely have to back test. There is no ifs, ands, or buts about it. Before you start trading this pair, please back test it so you can understand the behavioral moves that this thing does, because I'm going to show you some that are just wild and ridiculous on how big of the moves that this pair does make. Okay, so please understand that before you start trading this pair, please make sure that you back test. I can't stress it enough. All right, so let's go ahead and let's jump into the charts. Let me show you some different of the patterns that are out there, and we'll break everything down for you. All right, so literally, I mean, you could see these are all the cycles right? That I had marked off every single week, every single cycle. But let's zoom in here on the 15-minute chart so we can go over some setups here. So that way you can see what they look like and what they are. So you can see here on this day, we end up getting a type 1 setup here out of Asia. The Asian range is about 48 pips. Now on this, I want you guys to keep in mind that the number that it reads out here is a decimal off. So this Asian range is really 48.8 pips, not 488 pips. Okay? So that's one thing. So like this move here, this London range here is 91.8 pips. So the decimal is one off. So keep that in mind. All right, this is not 900 pips. All right. So here you can see we got a nice type 1 here, and you can see this is a prime example of what I was telling you, that if you wait for the next candle, which typically has a crossover in it, you see how big that candle is. Okay, now in this case, obviously it would have still worked out in your favor, but I mean, you could see that the risk to reward ratio here is about, a little bit over 1.5, just to get to the 200 EMA. And of course, I mean, you could have taken it way longer, right? But this is just being very conservative. Your stop loss is around 45 pips or so on this particular setup. Okay. This is on a Wednesday. So I believe this week was a market maker cycle because you had a full day of rise here. And look at that rise, by the way. New York session. Look, type 1 here. Look at that. You see you had this was the close. You had a close here above the 13. And also this actually happened to have the crossover as well. Look, you ended up getting a pullback here. So this pullback could have brought you in even a better entry here. You can see, but I mean, this entry still is about, 50 pips or so, even to the bottom. And you can see you get well over, close to a 3-to-1 risk to reward ratio on this type 1 in US session. Now, gold is going to be a pair that obviously is going to move a lot during the US session, because primarily this is a pair that does move a lot during the US session for obvious reasons, because we hold most of the gold. Okay, the US holds a lot of gold. Now, I did read a news story where the US is actually transferring a lot of that gold over to England, and so that's going to make things very interesting during the London session, where you will start to maybe see more setups during the London session because of it. Okay, but here you can see there's no clear setups. There's a setup right here actually. This is what, a type 1, type 2 almost right here. Look, first leg comes down, second leg, railroad track on the second leg. You get a pullback here. You see how the crossover doesn't happen until all the way down here. So this candle here is where your early entry would be. You get a pullback on that one here as well. So it would be somewhere around here. And you can see your stop loss is about maybe 42 pips or so. Your take profit obviously is going to be well over 2-to-1 risk reward ratio, but a 1.5 to 1 risk reward ratio, there's your trade set up there. Okay, and remember, look at the EMAs going straight through price. So very this looks like a market maker cycle, if I'm not mistaken. Yeah, market maker cycle. So this week is a market maker cycle. So there's that trade there. Here's another one, multi-session M. First leg here, second leg in the opening of the US session. You can see you get a pullback here on this candle, on this blue candle here. You get a pullback, there's your entry. That's also the crossover candle as well. And again, you could see about 45 pip risk to reward ratio, over 2 to 1 risk to reward ratio on this one, all the way to the 200 EMA. This next day here, you can see you had, this is a early trade. This is a trade out of the edge. Essentially first leg during Asia, second leg here, you get a star pattern here on the second leg. This is a crossover here. So this candle here is a crossover of the 5 and 13. So if you get in here, you're about 67 pips or so. If you actually do the candle of the star pattern on the second leg, then it's actually more like this. And then you can see literally you're talking about close to 50 pips. Now your risk to reward ratio is like a 3 to 1 risk to reward ratio. You see that? So there's another setup there. Here's another one as well right here. Beginning of the US session. Again, huge candle. You can see what I'm talking about with the big candles. So you can see what I'm talking about with the big candles there. I mean, it's just really, really, really unfair sometimes with the big pulls here. So you just have to be careful. You cannot let this go crazy on you, because it will take apart your account, guys. Trust me on it. It will literally take apart your account if you don't know what you're doing. So that's why I'm telling you to backtest it like crazy, because you want to make sure that you're comfortable with trading this pair, because this is just a different pair and it's a different animal. But the patterns, the cycles are there, and that's the main important thing. Okay, so like on this day here, you can see this was a Friday anyways. You didn't get a setup here on Friday at all. This actually could have been a type 3 depending on where that London section actually ended. 2, yeah, so that would not have been a trade, because that's not a it didn't go far enough. It would have needed to go down to the 200 here to be a type 3, but again, this would have been a trade that you would have missed. So what, move on to the next one. But you can see here, guys, look, you can see these big moves right here. Look, all the way up, straight back down again. Do you see that? That's 171 pip range during London. And you can see we're in a consolidation, right? We're in an accumulation cycle based on, just solely based on the EMAs. Look at the EMAs going straight through price. You're solely in an accumulation cycle that week. And look, here are 2 trades back to back. Here's a type 2 trading out of the edge right here. There's your crossover candles here. You get a pullback, your entry, 2 to 1 risk, or well over a 2 to 1 risk to reward ratio, 45 pip stop loss, and then you get the reversal in the New York session. Same thing. Look, 3 to 1 risk to reward ratio. Okay, 3 to 1 risk to reward ratio. There's a close above the 13 here. This is a crossover candle, and you can see if you take this all the way up here, you can see how much bigger your stop loss is going to be, about 50 pips or so. And you're literally right at, look, you're right at 1.5. So even if you take it after this candle, you can see you're still at your targets. Okay, and that's even in an accumulation cycle. Okay, you can see this day is really messy. Again, you're in an accumulation cycle anyway, so not a lot of trades that you can get here. This one here is on a reversal on a Monday, a type 1 setup. Look at this setup here. You can see first leg here, second leg goes all the way down. You get a railroad track actually on the second leg, and then this candle here that closes above the 13 would be your entry candle. You don't get a pullback, and you could see literally, you see how far back you gotta go. This is 90 pips, guys. You see, this would ideally, this would still fit your criteria, but the stop loss is too big. So this is what I'm talking about. This candle by itself is like 60 pips. This is one candle. So this is why I didn't have this marked up, because it just wasn't worth the risk on this one. But you can see, I mean, look at these crazy moves that this pair does. But you can still see the patterns there. This is on a Thursday. And so this should have been a trending cycle. It is, yeah, trending cycle. So you can see on a trending cycle, Wednesday coming into Wednesday, basically you get a type 3 here to go up, and then it reverses during the US session. You get a type 1 coming down, but then you see that during the Asian range just skyrockets up, straight up. I mean, this is obviously something where you wouldn't be trading anyways. This right here is FOMC news, by the way. Is the 2 o'clock FOMC news. That's why I did that. You can see here another type 2 setup here, trading out of the edge on a Tuesday. You can see Monday we basically went straight up. We passed. We're on top of and over the 200 EMA. You can see there we traded back around, created that nice type 2 pattern straight up. I mean, you could see on a lot of these trades, guys, you're gonna get more than 1.5 to 1 risk to reward ratio, but just to keep it on the safe side, that's just what I would recommend. Here's another trade here. Type 3 setup at the beginning of the US session, pins to the 50 right there. You can see it's about a 66 pip stop loss, but you can see 4 to 1 risk to reward ratio over 268 pips on that trade. This one here, 49 pip stop loss, over 2 to 1 risk to reward ratio to the 800. And it went down further, but this by itself with 117 pips. Okay, so guys, as you can see, the patterns are there, the cycles are there. There's a trending cycle here that just drops. Even on Friday, you can see it just continues to drop the whole week. Here's what I'm talking about, guys. When we have back-to-back trending cycles, back-to-back. Do you see that? So this is what I'm talking about. Look, back-to-back market maker cycles. So you can see what I'm talking about. Accumulation cycle, market maker cycle, back-to-back. So this does this a lot, guys. I notice this so much, that this does this behavior so much on this gold pair. Okay, but literally trending cycle, back-to-back. This is a triple one. Look, trending cycle. So 4 in a row, 4 weeks in a row of trending cycles. So this is a behavior that you can use back-to-back market maker cycles. So this is something that you can use, guys, to your advantage. This is a behavior of gold. Okay, that's literally a behavior of gold, to have multiple back-to-back cycles. Alright, guys, so now I can verify for you that gold does follow our strategy, and you can trade it using our strategy. Okay, so the only things that you have to make adjustments on are going to be the stop losses, the risk to reward ratios. The entries are going to be the same, patterns the same, cycles the same. Okay, of course, as with anything, go back and back test it yourself. If this is a pair that you want to trade, okay, if this is a pair that you want to trade, take your trading plan that you have now, right? Make the adjustments of the stop losses and the 1.5 to 1 risk to reward ratio, and then go back test it and see what you come up with. Okay, And remember that on gold, because the pip value is so high, you don't need to trade this every day. Okay? You don't need to trade it every day. Literally, like every single trade, there's a very high probability chance that every trade that you take is going to go about 100 pips or more. Okay? Just because of how it moves. So it'll be a pair that you don't have to trade every day, and you can be very patient with it. You can still trade your normal pairs. You know what I mean? But then if you want to, see what's happening with gold, and if you happen to be at the right time in the US session where, hey, there's something obvious happening, type 2, type 1 setup happening, or you understand what cycle you're in for the week, whatever the case may be, it's there and you can trade it. All right, guys. Thank you so much. Have a great rest of your week of trading.